Good evening, everyone, and thank you very much for taking time to join us this evening. We're very excited to welcome you to our first ever Thought Leadership Conclave, White Oak Quarterly Connect. This flagship quarterly event will be a forum to engage with our investment leadership team and our founder, Prashant Khemka, where they will share their investment outlook and thoughts. We greatly appreciate everyone who has joined us today for their interest in White Oak. On behalf of everyone at White Oak, I would like to express our gratitude and thank all our investors for entrusting us as stewards of their capital. It is indeed an honor and a great privilege. We would also like to take this opportunity to thank all our distributor and advisory partners for their continued support extended to us over the last 3 years. With support from distributors and clients, I'm happy to share that in a little over 3 years, the firm now manages an AUM of over $3.3 billion or close to 25,000 crores. Of this, 2.8 billion is from offshore investors, and we have little over $500 million from domestic investors, which makes us one of the fastest growing investment managers in India. A very big thank you. Before we start, some housekeeping announcements. There is an Ask Your Question tab on your screens. Please use the same to send in all your questions, which will be answered at the end of the session. There's also a tab on the lobby screen from which you can download materials on products and about White Oak. You can also make the screen full screen by using the tab on the right-hand side bottom screen. And finally, all feedbacks are welcome. There is a feedback tab also given on the screen. Please use the same to give us feedback. I would now like to welcome Prashant Khemka, founder, White Oak Capital, to kickstart the event and provide an update on the firm and the portfolio. Prashant has multiple decades of investing experience, having invested across developed markets and emerging markets. Prior to setting up White Oak in June 2017, he spent 17 years with Goldman Sachs Asset Management in various leadership roles. Most recently, he was both the CIO for the India equity strategy as well as the Goldman Sachs Global Emerging Market Strategy, where he was managing over $5 billion of assets. He has been investing in Indian equities for over 35 years in his personal capacity, and for the last 14 years in his professional capacity. With that, I would like to welcome Prashant and ask him to start the session. Thank you.
Thank you, Vivek, for the introduction. And thank you, everyone who's joined today. As Vivek mentioned, I'll kick it off. And then I'll have my colleagues also talk about some of the specific stocks that have helped our performance or might have hurt, as well as give their sector outlooks. Following that, I would come back to recap what our portfolio composition looks like coming into this year and what might be the general outlook for the year. And we'll open up for Q&A. So to start with, given the start of the year, let me start with what were the key lessons from 2020, as the title might give some insight, macro shakro. See, 2020 provided the most emphatic demonstration of a belief that we've long held, which is that predicting investment returns based on macroeconomic worries or events is futile. We're going to discuss this at length and we'll break it down into 3 sub-lessons. First, is that the usual perennial macro worries, what we call PM worries, of the well-known unknown variety are a colossal waste of time. We thought hard about whether to use the colossal waste of time or moderate it down, but we felt colossal is really the right word to capture the magnitude of time that is wasted on such worries. And we'll elaborate more on what kind of worries these are. These worries hardly influence the future returns from equity markets, if at all. To the extent some of these worries might affect, They are already incorporated in the market to begin with. Lesson 2, nobody has a crystal ball to forecast cataclysmic risk events of the unknown variety. As an example, the pandemic that we saw last year. And even if people were to be given perfect prior knowledge of the scale and scope of damage inflicted by some such cataclysmic risk event, the market implications of such developments remain completely unpredictable. Finally, lesson 3, investment decisions that are bereft of bottom-up analysis and instead driven by macro considerations are fraught with high risk of substantial absolute and relative losses. And several investors, I hope none on the call today, have suffered huge losses over the last 12 months, or huge relative losses, opportunity losses, in their attempt to time the market based on what they thought would be the market behavior based on macro considerations. Before we discuss each of these at length, I'd like to talk about White Oak's perspective in these matters. We believe that market value or value of the market at any time is present value of aggregate perpetual cash flows. So if Nifty were to be taken as a measure of the market, then the value of Nifty, the price of Nifty, is a measure of the value of aggregate perpetual future cash flows of its current constituents, the 50 names that make it up today. And we also believe that the market is fairly valued at all times, appropriately capturing these future cash flows, the probabilistic values of future cash flows, and the discount rates used for present valuing them. We view macro as source of random risks, not as an opportunity to add alpha. And we consciously avoid top-down misadventures like market timing, sector rotation, or whatnot, which might sound very entertaining and exciting to talk about, but if put in practice, they cost an entertainment tax in indulging in such activities. We stay fully invested with a bottom-up approach to investing in great businesses at attractive valuation, and always maintain a balanced portfolio construction approach. Many of you would have heard us talk about these at length, but if any of these are not clear after the conversation today, we'll be happy to engage separately as well. If we now go on to discuss the individual lessons. So lesson 1, the perennial macroeconomic worries of the well-known unknown varieties, which are a colossal waste. What kind of worries are these? So in the domestic market, or related to domestic market, obviously these worries are both asked by both domestic investors as well as global investors. It's a common list of worries for both sets of investors. It's just that some of them pertain to domestic developments, others pertain to global developments. The icebreaker of a question for most conversations is, what's the outlook on the market? As if anybody has a clue on what's going to happen in the market. It goes on from there to the economy. What do you expect GDP growth to be? Has it bottomed, or will it pick up? What could lead to a recovery? All these were questions at the beginning of 2020, if you recollect. Does the central bank have any ammunition left for monetary stimulus or bailout of struggling NBFCs? Would it even help in a credit-crunched financial market? Could it lead to inflationary pressures? Could currency be weakened in an environment where inflation is rising and growth is sluggish? Could India be entering into a period of stagflation? Often a favorite of domestic investors, what are FII flows looking like? Are they thinking about adding or are they thinking about withdrawing? Similarly, there is a long range of global worries as well. For the last 12 years since Lehman Brothers, people have been worried about Fed tightening. What will happen to the global markets and Indian market if Fed starts tightening, closing off the tap of liquidity? Remember taper tantrum when it was first mentioned in 2013 by Bernanke. The market experienced some volatility, very short-lived. Could this cause risk of outflows from GEM and India? And India being the high beta market, can't it face turmoil? And this year in particular, as happens in leap years, what if Trump loses? Won't market fall if Trump loses? Wouldn't lead to considerable volatility. Remember, 4 years ago, the question was, what if Trump wins? Won't markets suffer sizable volatility if Trump were to win? And this year, the question was reversed after 4 years, despite the track record that Trump had. And while people were worried about Trump losing, market had the best November in the last more than 3 decades, despite having what was the most feared outcome in the election, which is no clarity on what was happening on the day of the election results. Now, these kind of worries may sound important only because they are ubiquitously debated by fund managers and other market gurus or experts at all times in media and other conversations. That's the only reason for the importance. Otherwise, these worries have no impact whatsoever on what we stated earlier, which is our perspective that market represents present value of future cash flows of its constituent companies. A small increase in inflation or decrease in inflation or an increase or decrease in Federal Reserve rate has no meaningful impact of any significance on future cash flows and the present value of those future cash flows. And whatever little impact there might be, market already prices in the most reasonable expectations. And any insights, special insights that can be reasonably had, are in any case inconsequential to begin with, given the minuscule impact that such developments have on future cash flows. Remember, forgot to mention, when you're talking about present value of future cash flows, those are cash flows in perpetuity, and in most cases, and certainly for the market in aggregate, more than 80% of the value resides beyond 5 years. So a 0.5% change in GDP growth or 5%, even like this year, as you saw, when Indian market's going to be down high single digits, the economy is going to be down high single digits, it may cause an impact of 20 to 30% on cash flows of companies this year. But the markets are trading at 30 to 40 times cash flows. Forget about earnings. Markets around the world have been trading for quite some time at 30 to 40 times free cash flow, which means this year's cash flow is worth 2.5 to 3% of the value of the market. Even if it goes down 20 to 30%, that's barely 0.5% to 1% decline in the value of the market as long as future cash flows are not impacted. Let's go to the second lesson. So beyond the basic perennial macro worries lie cataclysmic risk events like the pandemic. Now, nobody has a crystal ball to forecast these events. These are of the unknown variety. By definition, you don't know about their occurrence until they have occurred. In fact, until the market has recognized their occurrence. Market implications remain unpredictable, though even if we were bestowed with perfect prior knowledge, So let's do a thought experiment of sorts, assuming that you are the prescient investor who knows beforehand at the start of 2020, if you were to know that a global pandemic lies ahead, which will cause 80 million cases and nearly 2 million deaths. Travel, now it's over 2 million deaths. Travel would come to a standstill, nationwide lockdowns, causing the most historic migrant crisis in India. India would have second highest infections and third highest casualties. It would be the worst year for the economy in our lifetime. Remember, at the start of the year, we were worried about whether economy might slow down from 5% to 4 or 3. Nobody was worried about as low as 3, but worry was, would it pick up or recover back from 5 to 6, or might it slow down to 4? Imagine that you were told that it is going to be the worst year for the economy in our lifetime. The economy would be down high single digits. To top it off, China would seize the opportunity to escalate tensions on our northern border and would result in the worst conflict with them in last 50 years, with several casualties on both sides. And Moody's would downgrade in India to the brink of junk status in the midst of all this. Only thing is that you are left with all this information at the start of the year to assess what would be the potential implication on the market as these events unfold during the year. I think it is very reasonable for all of us to agree, even though it's a hypothetical question. I assume it's reasonable for all of us to agree that we, any of us as an individual investor, would have said that 2020 is going to be the worst year, or if not worst, at least one of the worst year in Indian markets history, maybe paralleling or worse than the GFC crisis in 2008. Most likely would have pulled out of the market. So even what this illustrates is, even a cataclysmic event like the pandemic, which might be reasonably expected to cause very severe lasting losses based on perfect prior knowledge of what is going to unfold, might actually cause no damage at all. In fact, the market reaction last year, over the year, was the complete opposite of what could have been confidently forecasted. Markets were up about 15% or so, and many managers like us delivered a lot higher in a year that could have probably anticipated or expected or forecasted to be the worst year in India's Indian markets history. We go to the next lesson then. What is worst and what is the biggest lesson is one. So first and second is about worrying about these macros. Second is about that market implications that you draw might be very different even if you had perfect knowledge. The worst is, and the most important lesson, if you will, is that investment decisions that are made on the basis of such macro considerations are fraught with very high risk and can lead to substantial losses. The making of decisions is much worse than just worrying about them. And while most investors have been in a state of shock and awe since March to see the markets rally, and they've been scratching their heads about the dichotomy between the economy and the markets, the reality is that while investors expect the market to reflect current day reality, the market is a discounting mechanism and is looking ahead. What happened in March was the markets realized that the mortality rate from the virus is not as bad as it was feared. And hence, these lockdowns, national lockdowns around the world, are not going to last. And hence, the pandemic, while might have substantial damage for the society in terms of lost lives and livelihoods, would cause little damage beyond the current year or two, would cause little damage to long-term cash flows of the market that we talked about. And even if the assume hypothetically certain crisis might cause the longer-term cash flows to decline, but it could be also simultaneously that developments subsequent to the pandemic and because of the pandemic might result in reduction in discount rates for those cash flows. As an example, if you were told, as in the previous slide, that all these macro events are going to play out and damage would be inflicted, one would have expected widespread bankruptcies, as was the worry in February, March timeframe, especially in the financial sector, but even other sectors around the world, as was the case with GFC. But hardly any bankruptcies materialized. So that might prompt market to assign a lower equity risk premium because the perceived bankruptcy risk of investing in these equities are lower than what might have been feared prior to the pandemic. And beyond the equity risk premium, even the risk-free rate, there might be reason for it to decline because post-pandemic, we have seen rapid adoption of technology by individuals and corporates. Some of it Ramesh is going to talk about later. And technology adoption over the last 4 decades since the advent of personal computer and democratization of mobility and internet has resulted in declining inflation expectations. Technology has been very disinflationary, and which has resulted in lower interest rates rather than what everyone blames, liquidity from central banks. Now it's the technology advancements and the benefits of this technology era, which is leading to reduced inflation expectations and lower interest rates or risk-free rates. So it is possible post-pandemic, even if there is no effect or even negative effect on future cash flows, the discount rates for those cash flows have come down materially, as are reflected for the risk-free rate in the US long bonds, which are now down, which were already at very subdued levels, but are down further. So to base your decision merely on the impact of the pandemic on cash flows of this year, which could be minuscule, would be could be very detrimental, as unfortunately ended up being the case for many investors, hopefully not many on the call, or even fund managers who took big cash calls in March and missed out on what ended up being one of the best rallies of our and the sharpest and the fastest and the I would even go on to say the most logical rallies since March till date of nearly 90 to 100%, or 80 to 100%, depending on which index you're looking at. Let's go to the next slide, Nitin. So if this is, in the other deck, we will now cover the performance of the portfolio through this time period on slide 61. As you'll see on the left-hand side, our approach, bottom-up stock picking approach combined with a balanced portfolio construction approach has combined a risk management approach has delivered very consistent returns over the last several years, starting from 2017 when we started. The team has delivered since inception 21.8% annualized return compared to 10.2% return from the market, delivering an 11.5% or more of outperformance. And you'll see the outperformance is very strong in each of the years. 2017, when the market was up strongly in the last 4 months by 9%, delivered 21% return or 11 percentage points outperformance. 2018, while the outperformance is only 310 basis points, it was one of the best years of our careers, as most managers and most investors were deeply in the red, had substantial negative returns during that year, and we eked out a small positive return that year as well. 2019 also was positive, and then 2020 has beaten 2017 in being the best year for several of us or most of us in our careers, delivering 39% return compared to 18 of the market for 21% outperformance. If we go to next slide, what is equally remarkable as this top 1 percentile. So the magnitude of performance that you saw on the prior slide puts us in the top 1 percentile of peer group or thereabouts of the comparable peer set. What is very remarkable, as you'll see on this slide, is the consistency with which this performance has been delivered even on a quarter by quarter basis. So the middle column shows that 10 out of 14 quarters the team has outperformed, so over 70% of the time, at an average alpha of 233 basis points quarterly. On the right hand side, you see there have been 5 down quarters during this 14 quarters in the market. The team has delivered 4 out of 5 times, or 80% of the time, at an average alpha of 232 basis points. So the market's down 7.5%. The team was down 5.3% for an outperformance of 232 basis. And there have been 9 up quarters in the market, and we've delivered to clients 233 basis points of average alpha, and 6 out of 9 times outperformed. So market's up 9%, we are up 11.4. This is the beauty of the balanced portfolio construction approach, that when markets are down, we are down less, and when markets are up, we are up more. Obviously, combination with the bottom up, in combination with the balanced portfolio construction, you also need to have strong stock selection capabilities to deliver this top 1 percentile magnitude of alpha. If you go to next slide, you'll realize where is the source of alpha coming from, which is all in stock selection. The dark blue lines on the left-hand side represent stock selection. And if you look at the bottom row on the right-hand side table, 103% gross of tax and fees return compared to 38% of the market cumulative over 3.5 years, resulting in strong outperformance of 65%, which is predominantly driven by more than 100% of that comes from stock selection, 102%, and allocation effect is, if anything, minus 37%. And in each market cap segment, you'll notice, even in large cap, 116% compared to 53, very strong alpha. And in each category, stronger performance than the top performing fund managers in those categories. If we go to next slide, same is the story when viewed from a sectoral attribution perspective. The dark bars represent and showcase that most of the sectors have delivered robust alpha, stock selection alpha. And if you see the bottom row on the right-hand side, again, you'll see 70 out of 65% comes from stock selection, and allocation effect is a minor negative. Stock selection is considered universally, globally, by institutions as performance through skill, whereas allocation effect is more considered byproduct of luck or chance. The fact that all the performance coming from stock selection is what is more valuable than if it were the other way around. If it were other way around, it would be useless. If we go then to the next slide, what you'll see are some of the key contributors and detractors to performance over the last 3 years. They come from a wide variety of sectors and market cap segments. They're very well distributed. So law of large numbers is well at play. Not a single company makes or breaks the performance. Position sizes and risk management is also well at play because detractors are far smaller, whereas contributors are 8 to 10 times larger than the detractors. If at all there was an inference to be drawn about the character of the portfolio from looking at these names, it would be that portfolio is typically a portfolio of industry leaders or dominant players, or otherwise companies that are gaining market share on the back of strong management execution, which results in faster growth compared to the industry peers and the economy, as well as superior returns on capital. And we buy them and own them as long as they have maintained robust governance and as long as they are attractively valued as derived from our proprietary cash flow approach, which we call OpCo-FinCo approach, which I'm sure many of you are well versed with by now. Otherwise, happy to discuss separately. But at this point, it's been about half an hour that I've been talking. I'd like to invite my colleagues, maybe starting with Manoj, to discuss some of the names that appear here or their sector outlook. So Manoj covers pharma. So he's been a founding member of the team at Whito, and he covers pharmaceuticals and chemicals besides other segments. And several of the names that you see here in the contributors are names under Manoj's coverage. So Manoj, over to you.
Thanks, Prashant. And before we have Manoj come on, just quickly to remind everybody that they can ask questions from the Ask Your Question tab at the bottom of the screen at any point during the session. Prashant already introduced Manoj. So in this next segment, we'll hear from 3 of our senior investment team members on the contributors that Prashant spoke about. Over to you, Manoj.
Thanks, Vivek. Good evening to all of you. Thank you very much for having your trust and confidence in White Oak. And on behalf of the entire White Oak team, I assure you that we will continue to work hard to generate the best industry returns for all of our clients' portfolio. Now, today I'm going to talk on Indian chemical industry, which is at the cusp of multi-year structural growth as more and more companies across the globe are looking for an alternative and supply chain outside China. As you may be aware that China is the dominant player with 37% market share in the US 4 trillion chemical industry, while India had just 4% market share globally, which provide it a long-term growth opportunity. Even if Indian chemical companies is able to take few percentage market share from China, it can see healthy double-digit kind of growth for a long time to come. While MNC companies have started looking for alternative and stable supply sources of key starting materials few years back, as China government has decided to curb pollution, and this has further accelerated post-COVID as everyone is now looking for China plus one sourcing strategy. In our view, this provides an enviable opportunity for Indian manufacturers who have access to skilled labor along with environmentally compliant facilities. Similarly, Indian pharma and agrochemical industry, who procures over 70% of the key starting material or key intermediates out of China, are either now looking for backward integration or are encouraging domestic manufacturers to produce in India. We believe Indian government's product-linked incentive scheme to make India self-reliant in basic intermediates is a step in the right direction, and it will further strengthen India's position in specialty chemical or APIs. As you know, that India is already being considered as the pharmacy of the world, given they have a very, very strong position in the generic pharmaceutical industry. In our view, companies with strong R&D capabilities, presence in niche chemistry, and healthy balance sheet will be long-term beneficiary of this underlying trend. Now, when we look at any company in this sector, our focus is always on capabilities rather than opportunistic profit, which might have come because of demand-supply mismatch. In our view, companies that have superior management and strong R&D capabilities are best placed to show value accretive growth for a long time to come. Now, we own a couple of companies in chemical sectors, including, I think what Prashant has highlighted, some of them are being the top contributor, like Navin Fluorine and Fine Organics. In the interest of time, while I will not go into detail of each of these companies, but briefly today talk about company called Navin Fluorine, which we own in the portfolio. Navin Fluorine is one of the few companies in the entire Asia Pacific region which have a strong and dominant position in fluorine-based chemistry. And it is currently working with 8 out of top 10 global pharmaceutical companies, innovator companies, as well as large agrochemical companies, both in specialty chemical as well as in contract research and manufacturing services. Navin, a part of Arvind Mafatlal Group, started its journey 5 decades back as a refrigerant gas manufacturer. But over time, it has moved up the value chain, and currently 55% of its revenue comes from high margin CRAMS and specialty business, which is further likely to go over 75% in next 3 to 4 years. Despite Storm being up almost 150% and 300% over the past 12 or 18 months, we continue to believe that it has a long runway to grow. We believe Navin Fluorine will continue to gain market share in fast-growing fluorination market on the back of strong execution, and while doing so, generating superior returns on incremental capital, as well as maintaining very sound corporate governance. Thank you very much once again listening to me patiently, and I hand over the platform back to my colleague Vivek. Vivek, over to you.
Thank you, Manoj, for those insights. I would now request my colleague Ramesh Mantri to provide his thoughts on the IT services sector and talk about some of the contributors from that sector. Ramesh has 17 years of experience in investing and financial analysis across sectors. He joined us on day one at White Oak. Prior to joining White Oak, he founded Ashoka Capital Advisors that advised the fund and family offices on equity investment in South Asia. He began his career with CRISIL and covered the financial sector. Over to you, Ramesh.
Good evening, everyone. I'm going to talk about technology services in India. The COVID crisis has been a blessing to the industry. Whether in our personal lives or business, for the first time, we have consumed a lot more technology, whether we have used e-commerce, whether using technology in education, health, banking, entertainment. Both consumers and businesses have been forced by this crisis to adopt technology. And that way, the COVID crisis has been an accelerator to technology adoption. Often the question that comes with IT services, and it's an argument I've heard many years ago, that this is a mature industry, this is a sunset industry. However, if you look at the data, you would arrive at a very, very different conclusion. If you look at the Indian IT services industry, it's $150 billion in revenue, has grown at 11.5% dollar CAGR, 3.6 times in the past decade. You have 5 companies with revenues over $8 billion. And by the way, they operate in one of the most globally competitive industries in the world. Indian IT services companies over the last decade have expanded their market share from 6.6% to 11.6%. And they've taken market share from American companies and European companies like IBM, DXC, Capgemini. When I was looking at technology 15 years ago, it was difficult to believe that Indian IT services can beat the like of IBM or HP or Capgemini. But today that is true. We often forget how strong India is in technology. When you look at the global ER&D centers that get set up globally, now in 2019, 47% of those global centers were set up in India. Global companies like Microsoft, Google, Amazon, outside of US have the largest technical setups in India. No wonder companies like Google, Microsoft, or Adobe, some of the best tech companies in the world, have Indian CEOs. So clearly, this is an industry that has a long runway to grow. Remember, this industry, even at current scale, we only have 11.6% market share. So clearly, the industry is $1.3 trillion and still growing at 6% faster than the global GDP. So clearly, there's a very large room to play for Indian companies. Often we fail to appreciate that the companies like TCS or Infosys are among the top 3 best run IT services companies in the world. So clearly, and we have a lot of trends that favor technology sectors and changes are happening in technology sector. We're seeing significant adoption of cloud computing, and that itself will lead to a lot of apps modernization. You have businesses have to deliver now customer experience on apps. So digital experiences for business have to improve. Every business physical has to have an omni-channel now. And clearly there's threat of cybersecurity. And of course, data has become super critical and there are sensors in everywhere. So clearly the use of data analytics is growing. And of course, this big trend of work from home is helping Indian IT services simply because it doesn't matter today. If you're working from home, whether you're housed in New York or in Bangalore, how does it matter? Because you're not physically present. So Indian technology services industry is well positioned. Most large companies are looking at double-digit growth. And mind you, these are dollar growths. If you adjust for long-term rupee depreciation, which on average has been 3 to 3.5%, the large IT services companies will grow at 15, 16% on rupee terms. And then you have mid-cap, some of the mid-cap companies, which potentially can grow at 20% a year. And I would like to say the quote by Satya Nadella, that he said that 2 months after COVID happened, that 2 months of COVID has accelerated digital adoption by 2 years. Even now, the COVID is going on. The longer this crisis lasts, the faster the technology adoption is going to happen. And as recently the TCS CEO Rajesh Gopinathan said in an interview, that whatever the problem was in the last few years, technology was the solution. Coming to our portfolio companies, in terms of what has, one of the companies that we own in our portfolio is a company called Coforge. A lot of you know by its old name, Nit Technologies. It's got rebranded after Bearings. It got acquired by Bearings Private Equity. Now, Coforge is a classic case of the difference between stock picking and macro investing, what Prashant talked about, how macro themes can make you make large errors. This is the reason for that is at the start of the year, Coforge had 30% revenues coming from travel and transport. Half of that came from airlines. So frankly, this was the worst positioned technology services company out of India. 15% revenue from airlines, which just in the June quarter fell by 60%, despite the fact that Coforge actually gained market share in airline business. So they're exposed to the most difficult industry, and yet Coforge has been one of the best performing stocks in 2020. Why is that? This is because this company has very strong capabilities in insurance, 30% of the revenues. They have very strong technology platform where they gain a lot of business. They've also gained a lot of new orders in BFS space and also new verticals that they are building in high tech and life sciences. This company had seen a management change 3 years ago when Sudhir Singh had joined, and he was able to bring A-class talent from top technology companies. And today it's a completely transformed companies. And it's our focus on the micro aspects of the business helped us, stay invested, and it has been one of the best performing technology companies. The other technology company in our portfolio, which is again very different from traditional technology, is Lnt Technology Services. How is Lnt Technology Services different? Lnt Technology Services provides engineering and R&D solutions. They don't provide traditional solutions to banks to run their IT platforms. They actually help to design, entertainment systems in aircraft. They help to design electric vehicles, autonomous vehicles, semiconductor chip, gas plants, specialty chemical plants. So very different capability. Frankly, the best engineering capability of L&T, which we all know is the best engineering company in India. So the best capability of L&T has been housed in this company, catering to the global markets. And today, L&T Technology Services, has out of the top 100 R&D spenders in the world, has 50 of them as customers. This is a significantly underpenetrated market than even IT services. And L&T Technology Services, in terms of capabilities, is among the top 3 in the world. So clearly, it is one of those companies that has a very large runway to grow, very deep capabilities, a management that's clearly aligned, and we are very, and it remains an important position in our portfolio. I have a lot to talk about technology, but in the interest of time, I'll stop here and over to you, Vivek. Thank you, everyone.
Thank you, Ramesh. I would now request and call up my colleague Parag, who covers financials, to provide his perspective on the financial sector, and he will also cover one of the stocks in the portfolio which contributed to performance. Parag has over 30 years of experience in institutional equity research in banking and financial service institution. Prior to White Oak, he worked as a lead analyst for Lnt Capital, and before that, he worked with Macquarie and other brokerage firms covering the BFS sector. He is highly rated by marquee institutional investors for his original think pieces and primary research work. Over to you, Parag.
Thanks, Vivek. So, few things on the banking sector. If you look at banks or a credit penetration in India, it is far lower if you compare with the most of the developing and other developed countries. So, I think Indian GDP is set to grow in the nominal terms by around 11-12% odd. And if you look at the credit penetration, which is lower, the banking system or a credit system in India can grow at around 3-4% higher than the nominal GDP. If you look at the structure of the lending system in India, still PSU banks accounts for more than 60% market share. We believe that over a period of time, PSU bank market share should steadily decline. Even in addition to this, few private sector banks or even few NBFCs, which are very weak, capital starved or have no great lending practices, should also lose market share, because of which the well-run private sector banks in India should definitely grow even much larger than the overall banking credit growth. So we are very convinced and bullish on overall private sector banks and few NBFCs in the space. Now, coming specially to Mutud Finance, this was one of the stocks which we bought just after the IL&FS crisis. When we bought Mutud, it was considered as a sleepy South Indian company because during those period, during pre-IL&FS crisis, majority of NBFCs were growing at 25% plus. I think 20% was a norm, and many promoters, etc., wanted to start NBFCs because NBFCs were darling of the markets, and all of them were growing more than 25-30 odd percent. And that time Mutud used to grow at 10-12%. But if you compare Mutud Finance, so they were doing lending against gold, which offers very high level of security, and it is most liquid. Because of the strong brand name, lower cost of fund, and almost zero credit cost, because you have gold as a collateral, Mutud can generate 20-22% ROE, and stock was trading at a very attractive valuation of 1.5 times price to book value, and as per our valuation framework, our Opco Finco model, it was offering a very high upside. So at one point we have all the NBFCs which were though growing very high, have no great control on their underwriting practices, and post IL&FS it was quite known that they will have problems both in terms of growth as well as credit cost. And at the same time, Mutud, though the growth rate was much lower, was poised to gain a lot of market share, because few NBFCs were set to lose market share. So we bought Mutud at that time, and the stock did extremely well for us, mainly because, as I said, that other NBFCs in the space struggle for asset quality as well as for growth, and most of the NBFCs which were just throwing money by the way of personal loans or any other sort of loans, all those customers came back to Mutud for gold financing. When COVID unlocking was happening, stock actually did very well during, post IL&FS till COVID, even during COVID times, and the post COVID, stock was trading at slight premium to even one of the best well-run banks in India. Even it was trading at a premium to HDFC Bank on a price to book basis. So at that point in time, though we were very convinced on the stock, we were very convinced on the business model, the way they do business, the promoter, corporate governance, and everything. But since the stock has run up quite well, and there was opportunity in other stocks, we thought it was appropriate at that point in time to completely exit the stock. And again, if we get an opportunity, because the business model of Mutud is very, very strong, if we get the opportunity at a appropriate price, which offers an attractive upside, we may consider investing in Mutud Finance again. So I will stop here and hand over the call back to Vivek.
Thank you, Parag, for those thoughts. And now, without, just one reminder, please request you all to put your questions in the Ask a Question tab at the bottom of the screens. And I'll request Prashant to come back and provide some more thoughts before we open it up for question and answer through a panel discussion. Prashant, over to you.
Thank you, Vivek. Thank you, Ramesh, Manoj, and Parag. Let's open up for Q&A. Hopefully, there are lots of those. I'm told there are lots, so I'm going to try and be brief. But let's get it rolling.
Thank you, everyone, for sending in your questions. Please feel free to send in any further questions you may have. I'd like to address the first question to Prashant, perhaps you. And the question has sort of two parts to it. One, how do you sort of characterize the AUM that the firm has raised until now? To give some background on the color of the AUM. And two, how do you see the firm evolve from this point on with respect to new product launches or future growth?
So very quickly, we have, as Vivek mentioned earlier, about $3.3 billion or close to 24,000 crores. 80% of that is from offshore or foreign investors. About 20% or 4,500 odd is from domestic investors. The reason for greater tilt towards offshore investors has primarily to do with my background, where I have worked internationally for many years, managed developed world money for 8 years, including US and rest of the world, as well as managed global emerging markets for 4 years and managed obviously India for many years. And in doing so, interacted with investors globally, much more so over this time than India investors. With India-based investors, I've only really been interacting over the last 3.5 years in true earnest. Over time, we expect the India assets, as we get better known through these interactions and word of mouth, and first and foremost, due to strong performance of the team, I would expect the AUM mix over time to be more of a balance between offshore and domestic. We already have a good balance between different client types. So little over half of our assets come from global institutions like sovereign wealth funds, pension plans, and so on. 1/3 of our assets come from ultra HNIs like yourselves or family offices like yourselves. And that 1/3 is split quite evenly, half of that coming from India and half of it coming from outside India, from across continents. And then we have about low double digits percentage of assets also coming from endowment funds and fund of funds and so on. So that way the asset mix is very well diversified by client type and by geographical mix. It is very well diversified across outside India, from Asia, Europe, and the Americas. And from India, it is right now about 20%. But given the performance track record is building up, we expect to scale up in India as well and have more of a balance. In terms of future plans, as many of you might know, we expect to be able to offer mutual funds some point down the line. It is in the news and no secret that we are looking to acquire the AMC from Yes Bank. It is awaiting regulatory approvals. When that is received, we would be offering mutual funds. Mutual fund platform allows us to offer different types, lot more different types of products. So it's too early to start talking about them right now. Ashish Somaya, who joined us a few months ago, who was till then the CEO of Motilal Oswal AMC. Many of you might be knowing him or familiar with him. He joined us, and he'll be in charge of building the asset management company. So I'll pause at that on that one in the interest of time. If someone's more interested, we'll obviously on any of these questions, because I'm going to be brief, or we are going to be brief because of the number of questions, we are happy to elaborate further on a one-on-one discussion for if we don't do justice to the answer.
Right, Prashant. So I think the key takeaways, Prashant, are diversity of capital base, both within India and offshore, and even offshore, no particular concentration. Ashish obviously has his hands full with the future launch of mutual fund. I'll go to the next question, Prashant, which is again not surprising, but a key question is: our portfolio has performed well until now. From this point on, and obviously the valuations have increased. I think even though we have our own valuation framework, the P multiples that reflect on people's screen are relatively high. So do we envisage sort of keeping names that have performed well, churning the portfolio? So how do you see the portfolio composition going ahead, Prashant?
So look, I mean, I've been managing portfolios for last, if you include the global experience, for last 22 years, India portfolio for last 14 years. And obviously, and many of you, as you know, the performance has been, similarly strong, let me put it that way, over time. And they've not necessarily, the performance hasn't necessarily come from the same set of names every year. There are several names which have been in the portfolio for over a decade, but there are new names that keep coming in the portfolio all the time. The average name turnover historically would be approximately 30%. So when we buy a stock, we feel it's so compelling that we are going to own it forever. And Nitin, if you are able to share, then you can pull up the slide of 10 names, contributors and detractors, where we can see several of the stocks that we have taken action as valuations have increased. So we are very valuation sensitive. It's a very good question. We are not of the school of thought that if you buy something, you hold it forever, because there's no beauty, no charm in holding a company if there's no value upside, no upside left. The goal for the team is to maximize returns, and not, the team is not wedded to any slogans, if you will, on low churn or buy and hold and stuff like that. So as you see here on this slide here, in the top contributors or detractors, let's take Larsen & Toubro Infotech. Can everyone see the slide, please? Ramesh, Paraya. So Larsen & Toubro Infotech has contributed 11 percentage points to performance. If we had never trimmed it, I wish we had never trimmed it, but if we had never trimmed it, the position size would have been at least 13.5%, because its current position is 2.4%. It's contributed 11% already. So mathematically, its position size would have been 13.4%. But we have trimmed the position along the way, because when we first bought it 3+ years ago, the stock had 90% sort of upside. So we built it a sizable position of 5+% or somewhere there around. As the stock started rallying and doing very well, the upside shrunk. So let's say from 90%, the upside went to 60%. And the position size went up from 5% to 6-7%. While it made sense to have a 5% position at a 90% upside, it does not make sense to have a 7% position at a 60% upside. So for 60% upside, we might have reduced the position, and it doesn't happen in one fine day, but it is a continuum. And as the portfolio is always fully invested, 100% invested. So when we buy something, we need to trim or sell something, and we would trim or sell what is on the margin, become a bigger position for the relative upside in that. So in doing so, Larsen & Toubro Infotech would have been trimmed from 6% or so to 4%, and from 4% then to 3%. And right now also, we do have considerable upside, but it's adequate for a 2.5% position. And that's what the position size, that's the right position size in our view. And that's what we have. The other names that you see in the top 10, like Ipca Laboratories, it more than tripled, in fact, nearly quadrupled from the day we bought. And at peak, it had gone up to nearly 3% position. And at the end of November, we completely exited the name. And it's not that we had 3% and one fine day we went to zero. Along the way, as the upside declined in the name and we needed capital to buy other names, we trimmed from 3 to 2.5, 2.5 to 2, 2 to 1.5, 1.5 to 1, and finally on November end, when it was included in MSCI, we used that opportunity to exit the name. And the same is true from Mutud Finance. As Parag mentioned, we bought it first when it was 1.5 times price to book, and on our valuation approach had very strong upside, one of the strongest upsides in financial sector, and it was one of the largest name in our portfolio. Fast forward 3 years, now it's become a market darling. And the stock has performed very well, ahead of almost every other financial sector stock, and in fact went to a premium compared to HDFC Bank and other such leaders in the market. At which point there was hardly or no upside left, and so we exited that completely along with IPCA at the end of November. And similarly, other names also that you see here, at some point Lnt Technology was much larger name, and so on and so forth. So that is how, the position sizing is managed by the team to reflect the upside that they see at this time. And new names are coming in the portfolio at all times, and other names are getting added to, because not every name has gone up, right? There are detractors as well as some. It's not that if something is down, we just add de facto. Something is down might be reason to sell them. As you see, many of the names are zeroed out despite being down. But there could be other names which go down but represent compelling opportunity, and so we add to them, and they just haven't appeared on this list as of now on either side. Hope that answers the question, Rishi.
No, absolutely, Prashant. I think it does, and I'll pick up from Prashant.
I would say it's a great question, and it's a continuum that goes on with the team on an ongoing basis.
Right, Prashant. Thank you for addressing that. Prashant, I'll take a cue from where you left off. If you can keep on that slide, Nitin. If you look at the detractors, can you highlight any one detractor, Prashant, and just mention what went wrong with that name?
Certainly. I mean, look, this is a business where even the best would, have a long list of mistakes. There's no successful investor who has not made mistakes. Same is true with our team. It's like the best of the banks would have still have NPLs, whether it's HDFC Bank or Kotak Bank, they would have NPLs. If you become so risk averse as a bank to not have any NPL, you would not have a successful bank. And similarly for an investment team, if we become so risk averse that we don't buy a name which has a remotest risk of going down, then we would not have a successful performance over time. So there is a probabilistic investment. The future is probabilistic, and investment decisions have to be made based on where we see those probabilities in our favor. But because it is probabilistic, sometimes it's bound to go against you. To your question, more pertinently, though, a very good question, whether we see any common pattern. Various different names are down or are in detractors for different reasons. But let me still answer the question in saying, let's say, which have been one of the bigger causes over time. So for those of you who are familiar with our investment philosophy, the key attributes which I hope most of you are, so I won't belabor, but the three key attributes for a great business are superior returns on incremental capital, which has to do with its competitive positioning in the industry and the dynamics in the industry of competition. Second is the scalability, the growth prospects for the company. Can it multiply far faster and multiply manifold relative to its current size and faster than the industry peer group and the economy? And third is management, execution, and governance DNA. So if we separate the execution and governance part of the management, I would say several of the names here we have turned out to be mistakes, let's say, because of overestimating the execution capability of the management in context of competition or otherwise, overestimating the execution capability. Or there could be changes, like in case of Jyoti Labs, there was a change in management, which led to a reassessment for us in terms of our assessment of execution capability of the management. In Bajaj Consumer Care, again, it was a misassessment of execution capability effectively. They lost the risk appetite to expand beyond their hair oil category. And so it was combination of losing the scalability as well as overestimating the risk-taking capability of the management. And then, yeah, so in the interest of time, I'll stop there, as that would be, I would say, one of the single. But on the other hand, it is a subjective assessment, and many of the stocks that you see, companies that you see on the right-hand side as contributors, those assessments of management teams have gone very right in each of the 10 names, right? But some of the names like Coforge, it was a change of management, new management taking over. And it was our belief, and Ramesh talked about, the IT sector, it was our belief it was one of the strongest management teams in the industry, despite it being a small cap IT company. And similarly, Naveen Fluorine, these were decisions made on new managements, when Radesh Welling joined Naveen Fluorine a couple of years ago or so. It was, in our judgment, one of the best things to happen to the company, despite, in addition to the strengths that they have in fluorine chemistry and so on. So there are decisions and assessments of management that go very right, which may at the beginning appear to have some element of risk, and then there's some that go wrong. If we go into a shell and only go for the very tried, tested, proven managements of, and then we'll also, while we might avoid some of the detractors, we'll also end up missing out on some great contributors. In our assessment, the ability that the team has and the track record that the team has, I think has served us very well, in that the contributors have been far larger and much greater in number than the detractors. Though obviously it is incumbent upon us to keep on trying to increase our strike rate and learn from the mistakes that we have made in the past.
Right. Hope that addresses the question there. And it's ironically, execution is very, very important, not in every industry and sector and around the world. So thank you for that, Prashant. I'll let you have a moment there, Prashant, and turn it over to Manoj. And Manoj, one of the questions that come for the chemical sector is, you've seen the sector evolve over a period of time. Obviously, there were tailwinds that have assisted the sector over the last sort of 12 months, specifically now with the COVID situation. But how well do you think Indian companies have leveraged this scenario? And what is your take on their investment in R&D, which is obviously going to be very critical for them to be able to sustain the cash flows going forward?
Sure. Thanks, Rishi, for this question. So if you look at in terms of the Indian chemical industries with regard to the investment on the R&D side, I think Indian companies have come a long way. Today, when you look at in terms of fluorination chemistry, but probably we have spoken about Naveen Fluorine, or maybe company like, Fine Organics, which is primarily into green chemistry, and again, a part of our portfolio company, they have today invested significantly in terms of building up their capabilities, both from an R&D perspective as well as from the capacity perspective. Today, none of the company in China has the similar kind of capabilities when it comes to fluorinations. Even when we spoke about oleochemicals, which is basically a plant-based, derived kind of chemicals or a green chemicals, because when it comes to chemical, people start thinking about pollution, people start thinking about all the things which you can think about in terms of the bad names which are associated with chemicals. But look at Fine Organics, probably the only company in India which has the oleochemical drives product as the feedstock, and maybe one among the 5 companies in the world which has got those kind of capabilities. So as what I was trying to highlight during when I spoke about the sector also, that we are not looking for a small time kind of opportunistic profit, which might come because of demand and supply mismatch. But if you build capabilities and you work with the innovators, those capabilities are going to stay with you for the next decade, 2 decades out there. And that is where we would like to invest, because those are the cash flow which are sustainable over a longer period of time rather than the opportunistic profit.
Right. So longer term thinking as opposed to shorter term triggers that assist, your company.
And with a very, very strong management track record with regard to the execution. And I think that's what like Prashant has summed up very well. When we look at the great businesses, what are those three key attributes which we look at?
Absolutely, Manoj. Thank you for that. Ramesh, a similar question to your sector. I mean, I think your sector has seen, as you sort of highlighted during your presentation, a significant evolution over the last 30 years. And now the question is with sort of new technology, with AI, with cloud being buzzwords around the sector. I mean, do you think more traditional Indian IT companies are sort of, their days have gone? And are there new trends that are emerging? And how are those companies placed vis-a-vis leveraging sort of new age technology?
Sure. So one, all the new technologies that are coming in, whether, triggered by AI, machine learning, automation, analytics-led, there are significant accelerators to technology adoption across industries. Just going back to a few years, a couple of decades back, technology was focused on getting your accounting SAP platform. Today, technology is about acquiring customers, retaining customers through apps. Your customer experiences your technology first, then they experience the organization. And ability to identify, consumer trends through technology. So that way, technology is significant. These new technologies are significant accelerators to adoption. And today, even for the head of marketing, technology is a key focus area. Unlike earlier, it was limited to a technology head. In terms of capabilities, there was a period when Indian companies lagged behind global companies and startup companies in technology adoption. But now, last 4 or 5 years, Indian IT services has done a great job of investing in reskilling people into new technologies. I think we probably have the best, largest education program, training program in the world, Indian IT services industry, where they reskill people to new capabilities. And just give example, for example, today for Azure, which is the cloud solution from Microsoft, Infosys is the world's largest global partner. And today, companies like LTI are known for analytics and cybersecurity capabilities. So clearly now that field is changing and secondly, whenever businesses want to use a new technology at the start, they use a startup, small venture. But they want to use a technology at scale, they go with the big companies, the likes of TCS, Infosys, the big Indian IT companies, right? And that way, Indian IT services companies are very well positioned. And I want to reiterate again, we often forget that among the top 3 best managed IT services companies in the world, 2 of them are Indian companies, which is TCS and Infosys. Yeah, thank you.
Thank you for that, Ramesh. And just work from home, do you think that's going to well place the industry going forward? Or what are your views on that?
Yeah, so, I think work from home is a part trend that is here to stay, whether it's going to be 25% of people or 50% of time, that's, of course, time will tell. But it's very great for the Indian IT in the sense that Indian IT industry in the last decade has been facing increasingly restrictive challenges of, sending people to US through the visa regimes. And, work from home has let organizations realize that it doesn't matter much whether you're working from home in New York or in Bangalore. So clearly it has made work from home or offshoring more acceptable. And if US has made people going difficult into US, it only means that since technology unemployment in US is close to 0, basically the developed world only has to outsource technology. And that offshoring will come to India. And remind you, offshoring in India is 3 times more profitable for IT companies than onshoring. So actually, one of the reasons margins have expanded this quarter for IT services companies across the board is simply the share of offshore revenues have gone up, which is the high margin business. So it's a win-win for the IT services over a longer term.
Thanks, Ramesh. Very insightful. Prashant, just staying with the same trend of technology, what if our plans to get sort of White Oak up the tech curve and launch an online portal which makes our performance easily accessible to our investors?
So we've got this question a few times in the past, and I must admit, and even we apologize, we've not anticipated the ramp up in the number of client base, if you will, ahead of time, and the requests and different requirements to give top-notch customer service. But this is number one area of focus and attention for Ashish, and he's built a team dedicated for enhancing and vastly improving the customer experience in working with or in interacting with White Oak. I would, on behalf of Ashish, take the liberty to commit that we would, over the coming months, in this aspect, improve to be at the close to the top of the peer group, if not the very top of the peer group. Now, there are certain regulatory requirements and compliance requirements that we have no flexibility with in terms of documentation and whatnot, and we cannot take any chance with those. And you might find that on some of those, we might err more on the side of caution than maybe some others in the industry. But whatever is under our control and what we can fix, we are going to make the best out of that. I'm told that the NAV would be available online by early February, let's say 10th February. And we will be holding people responsible internally to that date. So please bear with us for another 3 weeks. In the meantime, the team is there available to provide that. I know it's not as comfortable and not as modern day with all the technology that Ramesh talked about as it is to check online yourself. But we would be providing that in 3 weeks, and in between, we're happy to provide. Our team would be happy to provide on an individual request basis.
Right. So around the corner, and I'm sure investors appreciate that. Taking a step back and sort of, Prashant, when we were talking about some of the characteristics that define companies when they're either outperforming or underperforming, we kind of spend some time on management capabilities, execution capabilities. How often do we see that underlying performance is driven by operational sort of efficiencies, outperformance, versus kind of multiple re-rating?
See, oftentimes it comes from combination of the two. It's like, to give you an analogy, to just for ease of understanding of a portfolio, let's say a fixed income portfolio, just for ease of analogy. We are not managing fixed income, but for ease of analogy, let's say we're managing multi-credit portfolio and we are investing AAA, AA, single A, triple B, and so on and so forth. If we find companies that the market is currently valuing as triple B, the bonds that are currently being valued as triple B, but we are convinced that it is a bond that is not going to default, it is a triple A quality bond, and we buy that, then we get the benefit of having a higher yield for the time that we hold because we are getting it at a lower price than a triple A. And at the same time, sometime in future, the market might realize and come to our point of view that it is indeed a AAA company and not a AAA bond, not a BB bond, right? And so they might raise the price from whatever 80, 85, 88 to 100 to come in line with our view. And oftentimes, it is this combination that drives extraordinary return over time for the portfolio. So many of the top 10, and it is very natural, very normal. In fact, we are looking all the time for companies that are undervalued by the company. And to give the bond analogy, the bonds that might be undervalued because people think those bonds might default in the bond analogy. So like LTI, when we bought it, it was 11 times free cash flow. Forget about PE multiple, which we don't care for and have a deep-rooted disregard for. For our cash flow multiple, as we look at it on OpCo cash flow basis, which is multiple of excess ROIC, it was trading at 11 times free cash flow when the market itself at the time was trading at about 40 times. And other peers in the industry were trading at high teens or 20 plus times. And this was a company that was one of the fastest growing companies and sustainably so, with one of the best managements, and was at a deep discounted value. And what has happened over the last 3 years is that not only have delivered that fast growth, faster than the industry, faster than the market has also come to realize that it is indeed a sustainable, great business model and management execution and all of the things that we like to see. And hence the multiple has also gone to reflect, at least to great extent or to some extent, what reality we always believed in. And at the same time it grew, it had one of the fastest growth in the industry as well. So it's a combination of those two that has delivered the 1,000 basis points or so of the performance, and the stock multiplying by 5-fold or so.
Thank you, Prashant. Just moving on to another sector, and Parag, you spoke about Mutud and how there was and is one of our greatest contributors to performance over this period of time. One of the questions that came up with the investor, even though we don't own the stock, your insights will be helpful, was given the softening of gold prices, do we see the future growth outlook for Mutud to slow down?
See, the gold price, it has no great significance on the stock, right? If you look at a typical borrower who wants to pledge their gold and borrow against it, will probably his requirement is steady. So let's say if he wants 25,000, 30,000 or 35,000 to support his consumption, or probably a small business which he or she is running, that demand remains by and large the same, right? It does not change or move with the gold price going up or going down. So that is one. And secondly, if you look at the unorganized market in gold finance, it is, I think in my view, it is 3 to 4x larger than the organized market. So there is enough scope for players like Mutud to gain market share from the unorganized players. So overall, we believe that the business for a player like Mutud in terms of gold financing should remain by and large steady, and they should be able to grow 15-16% in all sort of price for gold. Yes, there would be some 1 or 2 year impact, or probably a 6 months impact when you see a sharp correction in the gold price. That's possible. But over a period of time, I think this business can easily deliver 15-17% kind of a growth rate.
Thank you. So you continue to be cautiously optimistic on that name. I'd like to sort of throw a question to the panel, and please, anyone can step up and address this question. Prashant at the outset spoke about 80% of the value being contributed by sort of cash flows 5 years and henceforth, right? And how much a COVID impact and the impact of sort of degrowth this year has a negligible impact on sort of value, inherent value. I think one of the questions that came up was when we were discounting, how fair is it to discount future cash flows at today's sort of low, quote unquote, low yields, wherein one may not know sort of what lies ahead in 3 to 5 years?
Well, I mean, that is the reality, right? You never know what lies 3 to 5 years ahead. I mean, nobody knows, nobody can forecast their personal lives with any degree of accuracy 3 to 5 years ahead. Forget about forecasting, aspects that affect billions of people. So what you do is you take what is the market's best estimate of that on that metric in the future, which is the US long bond rate, 10-year rate, 30-year rate, and so on. And then whatever is the equity risk premium, I'm talking specifically about equity discounting here. So, in the mid 90s, when, I was doing MBA, the long bond rate was 6 to 7%, and we'll take on 5 to 6%, call it 5% of equity risk premium. So the discount rate was 6% plus 5%, which is 11%. Today, the same math would be possibly in dollar terms. Today, the same math would be 1% plus 5%. Even one can argue 5% is too high and should be reduced because equity risk premium would also be impacted by reduction in risk-free rate. But even if you take 5%, it is 1 plus 5%, it is 6% rate. And that's perfectly logical. It would, in fact, be very out of norm and illogical to still continue to use 11% discount rate. You'll miss out on most opportunities. You'll end up sitting in cash, which would generate 1%, for you. So, a lot of investors are worried about, obviously, the PE multiples. I'm not saying not to be worried about, but they've always been very worried about PE multiples. And they keep comparing it to the last 30, 40 years of what the PE multiples of the market has been. But remember, the multiples of the market, the cash flow multiple, which then, impacts the PE multiple as well. These are all relative, and they're relative ultimately to the ultimate benchmark for valuation, which is the US long bond rate globally. 10-year, 30-year long bond rates used to be in the teens in late 70s, early 80s. Following the shock, the oil shock, inflation had gone to double digits in the US. And hence, these long bond rates, and rates are a function of long-term inflation expectations. So because of that oil shock and spike in inflation expectations, interest rates about 4 decades ago were in the double-digit space. And coincidentally, since then, around that time, the technology era basically took off. The advent of personal computer, then mobility, then internet, and technology is very disinflationary. It is because of technology that prices of commodities also are possibly under containment. If you think of what are the key drivers of inflation, I'm going about in digressing in various aspects, but I always get a lot of, and I'm sure Rishi is seeing a lot of questions related to this topic about PE multiples and valuations and all. But technology has been very disinflationary. 2 legs of inflation are commodities and wage pressures. Now, in commodities, oil or coal or fossil fuels in general are the biggest driver of commodity inflation. Now, it's because of technology that shale oil, which was there under the ground for millions of years, has finally been able to come out. And it's proven to be one of the largest source of oil, which is outside the OPEC cartel or cartel in general. It's driven by hundreds of capitalist producers, and it's put up more or less a permanent kind of lid on oil prices, right? Also, due to advancements in solar energy and electric vehicles, these were concepts that till a decade or two ago seemed to be limited to laboratories, but now very much are implemented in practice. Because of these advancements, we have a completely alternative mechanism of transportation, which completely avoids fossil fuels, coal as well as crude oil. You tap energy from solar, from the sun, charge the batteries, and that would run the cars. Now, that is not happening at a wide scale today, but that's where the future is headed 10 to 20 years ago. Just like in mid-90s, when internet was just coming in, we weren't reading newspapers on phones. There were no smartphones at the time, and would have seemed very far-fetched down several generations to expect us to read newspapers on phone. Now, almost everyone on the call here, especially over the last 12 months, would have read newspapers on the phone, and as in general, read newspapers on the phone. So similarly, these solar energy plus battery driven vehicle is going to make, that's what the markets are also telling us, and then seems most logical that it's going to make the combustion engine vehicles face a similar fate as newspapers, and that is going to break the back of commodity inflation, is the market expectation quite possibly. And similarly, with all the things that are going on with artificial intelligence, machine learning, robotics, and so on, and drone delivery, which are again being implemented, all these in US already, and matter of time it spreads around the world. In India even, surveys are being done by drones. So these are all going to keep a lid on wage pressures. And that's why US, despite having a terrific growth over the last 10, 12 years, hasn't seen, and low unemployment hasn't seen inflationary pressures in wages, wage inflationary pressure. So because of technology advancements, which is only tech era is we are only 4 decades into it. The industrial era lasted for nearly 100 years, 75 to 100 years. We are only 4 decades into tech era. And if this continues, the adoption of technology, and pandemic has only accelerated it. And one of the reasons for the markets to rally could be this faster technology adoption is going to result in, further reduction in inflation expectations from their already subdued levels, which would then merit lower discount rates and hence higher multiples. So I don't see it as an aberration. I see it as a logical thing to do. If you are, as a businessman, evaluating projects, you are going to use a lower interest rate today than what you were using even in India in 80s and 90s. In 80s, 90s, the interest rates were a lot higher and the discount rate for business projects would have been a lot higher. And today it ought to be a lot lower. Otherwise, you won't be able to conduct business. Your competitors would win and do all the projects rather than yourself if you have too high an interest rate. So I answered a few questions in there, but that is the response to this particular question, Rishi.
Right, Prashant. Thank you. And I know we've gone a little ahead of time. There are a few questions remaining. So, let me start with one of the most common themes coming out, Prashant, and this goes back to where you started.
Rishi, let's do a rapid fire on both sides. You also fire rapidly. I'll also answer rapidly.
Okay, let's keep it at that, and let's keep this concise. Markets. It's our favorite question. Comes back to the lessons we've learned. Good time to deploy, time to sell. Should I invest now? Is it too hot? What is your deployment strategy? Are you cautious? Are you looking to deploy all in? Just overall markets, Prashant.
So we never take any market timing calls. We are always invested. Cash levels at close to 1% or thereabouts, you must assume. Market timing call we leave to investors or their advisors. We maybe are biased as well as conflicted. Sometimes I see people ask me, what is your honest opinion? As if they expect us to be dishonest and say invest in the market. So yes, we are conflicted and we are biased. For last 35 years at least, 100% or more of my net worth has been invested in equity markets at most times, right? This slide, thanks Nitin for bringing it up. And that is on the back of this experience this graph that I personally experienced. To us, fixed deposits are a guaranteed real loss. Starting from 85, when I started investing in equities, if you had invested 1 crore in fixed income with SBI, it would have been 8 crores today, post-tax. Inflation itself would have been 12 crores. So fixed income is a guaranteed real loss, not only in India, but everywhere in the world. And that's the reason why in countries where you have low inflation, like in Europe and Japan, you have negative interest rates. Equity market, on the other hand, has delivered in line with nominal GDP growth rate of about 15%. If you add plus the dividend to that, 1 crore would have been 115 crores. And someone who can add 10 percentage points on top of the market return, 1 crore would have become 2,200 crores. Now, I didn't start with 1 crore, to be clear. I had a paltry 5,000 rupees in my piggy bank. But what I'm saying is, even going forward, this opportunity exists to outperform the market by 10 percentage points or more. The market might not deliver going forward 15% return, but we do think over extended periods of time, as has been the case everywhere in the world, developed and emerging, or most places around the world, over decades, markets deliver in line with nominal GDP, the return. And let's say going forward, nominal GDP growth rate for India is low double digits, 10 to 12%, call it 11. We expect to deliver 20 to 25% return with robust outperformance on top of that. So if I were to be consistent with what I do and I put my money behind my mouth, I would say to be always invested. Yes, if you've had a windfall event of liquidity, you might want to stagger in the market, spread it out over a few months or several months. That would be like buying insurance. It would be negative NPV, but all insurance is negative NPV. And that might be, a good way to take care of the risk.
Thank you. I think that sort of broadly addresses the question around markets, attractiveness, timing, deployment strategy, Prashant. So thank you for taking sort of a fairly broad question. Coming to a few specifics, we've obviously, as you highlighted earlier, seen some churn. name changes, etc. Airtel was one that we saw, in our portfolio. I think an investor would have seen that in our portfolio till about the first half, but now it's no longer there in the portfolio. Speak a few minutes, Prashant, on Airtel, and Ramesh, please feel free to jump in.
So I'll be very quick. In Bharti Airtel, the team was wrong. We went wrong. And if you think about the three attributes where we went wrong in terms of assessing superior returns on incremental capital, scalability, and well managed, it was to do with the superior returns on incremental capital. I think we were too early in jumping to the conclusion that with the consolidation in the industry down to three players, with Jio, Bharti, and Voda itself struggling to survive, that the future returns on incremental capital should improve dramatically and quite substantially. However, we later realized that it is not, at least not happening at the pace that we would have anticipated, and there is much greater uncertainty around it than what we had originally anticipated. Recognizing the mistake, we exited. In fact, exited before the holding did much damage to the portfolio returns, if at all.
Noted. Noted. Ramesh, anything to add onto that?
No, I think, no, nothing to add.
Great. A topic, Prashant, that we're seeing now come up globally is around ESG, and sort of, how is our portfolio sort of placed from an ESG perspective? I think, Prashant, if I may, start addressing it, and then you can please elaborate further. And I think, one thing I want to highlight is both sustainability of returns and corporate governance form a fairly important element of our investment philosophy. And our investment approach actually naturally integrates the key facets of E, S, and G, all of which are included in our decision-making process. Because fundamentally, we believe that sustainable investment strategy preserves sort of long-term shareholder and sort of stakeholder value. But Prashant, you've been an investor over sort of more than 2 decades now in your professional life. You've seen this buzzword especially come up in the next 5 years. Please, give your views around this topic as well.
See, ESG has gained, increasing importance around the world for investors. See, the way we invest, our philosophy, even though ESG is not the starting point or the starting objective, what we have seen over the last many years that our portfolios score very highly on any ESG scoring metrics. And primary reason for that is reasons, on governance. For the team, governance is very much the starting point of the analysis. If governance is not appropriate, we don't even dig deeper into such companies, because even if you have superior business, superior cash flows and scalability and all, it's a great business only for controlling shareholder, not for us minority shareholders if governance is inadequate. Because of the focus on governance, we score very highly on the G of the ESG. Now let's talk about E and S, environment and social. See, again, going back to our mindset or perspective, that value of a business is present value of future cash flows in perpetuity. If a company is indulging in something that is socially unacceptable or environmentally unacceptable, the business would not last in that form for too long. If you see how the world is evolving and developing, the business won't last. It might end up being a finite time frame project, in which case, in our assessment, which is present value of future cash flows, the company would never stand out as attractive as compared to, let's say, what the marketplace might be valuing it at on near-term earnings or something. So hence, for most part, our business, our portfolio ends up having a very strong composite ESG score. And just as a policy, we don't invest in cigarette companies.
Right. And again, I think the key highlight there, Prashant, as you mentioned, perhaps a new buzzword in the global world, but it's always been inherently incorporated into our investment strategy and philosophy. I believe we've addressed most of the investor queries that have come in. If there's anything else, Prashant, you'd like to add on, else I'm happy to sort of close.
I think we've taken up a lot of investors' time, and very thankful for them to have engaged with us, have attended the session, and asked a lot of insightful questions. Hopefully, all were answered. Several were not directly raised because there were other questions that were similar in nature and hence combined by Rishi with those other questions. But if anyone feels that their questions have not been addressed, please feel free to reach out to us separately, and would look forward to engaging with you on a one-on-one basis. With that, on behalf of the team, from the investment team side, we'll say goodbye and turn it over to Vivek or the moderator, as the case may be.
Right. Thank you, Prashant. I think we'd like to thank all of you for. We'd like to thank all of you for taking the time out and attending our first ever sort of thought leadership conclave. This is going to be a quarterly event now, so we look forward to seeing all of you next quarter. And as Prashant highlighted, we're always available. So if there are any questions that have either been unanswered or that come up in the interim before the next quarterly call, please feel free to reach out. You know how best to reach out to us. And we'd like to wish you and your loved ones all the very best, and stay safe and stay healthy.